Vitale American Retirement Advisors with the Gradient Investments weekly talking points for the week ending November 3rd, 2023. Let's get into some stocks. Stocks rallied globally after the Federal Reserve kept interest rates unchanged. The benchmark S&P 500 gained almost 6% at 588. The Russell 2000 marched ahead by 7.59 and the NASDAQ was up 6.62%. Now overseas, the developed markets, which is the EFA, rose 4.43, while the emerging markets gained 3.13%. Small caps outperformed mid and large cap stocks, and gains occurred across all the U.S. sectors, and real estate and financials were the best performers, while energy and consumer staples were the laggards. Now, we've seen this year has been a nice rebound from last year, but we're still behind. So we've got 2 years with no growth. Some sectors you're seeing a lot differences, a lot bigger swings. So again, 2 years, a lot of our accounts are still behind. Let's talk about fixed income. Interest rates fell and bond values rose following the Federal Reserve's meeting midweek, in which they agreed to keep interest rates unchanged. Now, the Fed announced that pressures on labor costs appeared to be in check, reducing pressures for further hikes to curb inflation. The Fed also stated that longer-term inflation expectations appear to remain well anchored, as reflected in the broad range of surveys. Likewise, the Eurozone central bankers met and unanimously agreed to stop raising interest rates for the first time in 15 months, following a steep drop in inflation for their area. The benchmark 10-year Treasury fell 27 basis points to end the week at 4.57%. So we're going to see this now. Hopefully, as we see the interest rates go down, God willing, we'll see in the first half, we'll see those kind of come down. The market should rebound and go further because people are going to look for better rates of return, which they can't get in the treasuries. Commodities. The price of cobalt has dropped 35.7% year to date. Demand for cobalt has decreased with falling electric vehicle sales in Europe and China, and as battery production shifts to cheaper cobalt-free materials. With the lifting of export restrictions from the largest producer earlier this year, the combination of excess inventory and reduced demand has driven down the price. It's good news, so hopefully should we see electric vehicles reducing costs? We shall see, but I don't know. Let's talk about economic data. Total non-farm payroll employment increased by 150,000 in October, below the consensus expectations of 179,000. Also, employment in the months of August and September combined was lowered by 101,000. The unemployment rate edged up slightly to 3.9%. Wages in the last year increased by 4.1% in October, lower than the 4.3% that they were hoping for, which was seen in September. And Friday's report confirmed that the Federal Reserve's midweek view that labor supply and demand is becoming more balanced and less inflationary. That's kind of what they were looking for. Home prices for the major 20 metropolitan regions rose 1% on the month in August, beating the consensus estimate of 0.7% gain. The unadjusted annual rate rose to 2.2% from July's growth of 0.2%, and shortages of home availability for sales are driving prices higher despite nearly 8% mortgage rates on a 30-year loan. Leading cities were Chicago, New York, Detroit, while the worst performers were Las Vegas and Phoenix. We're still seeing not a whole lot of inventory on the market right now. Some homes are sitting on the market, but the ones that are in demand are going super fast because there's still not a lot of inventory. People aren't going to be selling their house with an 8% interest rate unless they really have to or getting out of Dodge. Let's talk about company news. Advanced Micro Devices, AMD, which is a core selected G33 holding, reported last week and beat on revenue and earnings. Management forward guidance was in line with consensus expectations. Data center demand and artificial intelligence continue to be the primary growth drivers, and shares of the semiconductor company rose 6.41% for the week. Again, AI, it's a big part of it. Apple, which is a core select and G33 holding, reported revenues and earnings that exceeded consensus expectations. Management guided the current quarter's results to be flat on a year-over-year basis, which is below the expectations. They were more conservative regarding the holiday selling season than some investors had hoped. So they got a little mixed reviews for that, but shares were up 5% for the week, which is good. Apple's always good to have in the portfolio. I think that's one of those to just hold on to forever. We like that in our portfolio. Starbucks, which is a G50 holding, reported both revenue and earnings that were stronger than consensus expectations. Same-store sales were up 8%, driven by U.S. demand for higher-priced drinks. and shares rose 11.5% for the week. A little crazy, isn't it? But we're coming into the holiday season right now. Typically, we're going to see the fourth quarter rebound do a little bit better. Remember, the first half of the year, everything was really coming back strong, and then we had that dip, a little bit of a pullback for a couple months, really. Now we're starting to see it come back a little bit, still trying to erase some of those losses from last year. But that's kind of across the board. So that's about it for this week. Thank you so much for being part of our ARA family. If you'd like to get a hold of us, give us a call at 810-678-3333, toll free 855-756-5700. Visit us at aradvisorsinc.com. Remember, with all the ups and downs in the market, we got to have that balance. Everybody, when you're looking at the indices, when you're looking at what's happening, last year was down anywhere between 15 to 35%. The rebound was only 10 to 25. So still, if you were in the sectors, the S&P sector, you're still down 10 to 15. If you're in the NASDAQ, you're still down 10 to 15. Our G50 portfolio is pretty much flat, barely lost anything last year and up a little bit this year. So back a little bit. So diversification is huge. We have to make sure we stay the course, because even if everybody's like, oh my gosh, Joe, what if we go doom and gloom? What if everything happens? We don't know. Nobody's got that crystal ball. But remember what happened in 2008, the Great Recession? I don't think that's going to happen again. But if that ever did, stay the course. You're going to be okay after a couple of years. But the most important thing is having that money in safety, being properly diversified, not putting all your eggs in the market. You have to have that safety where you can always pull money as needed. We're doing a lot of income planning. We're also we talk about Roth conversions, diversifying from legislative risk, making sure that we've got money in the proper channels. So no matter what happens with the government, no matter what happens with the dollar, for the most part, we're going to be as protected as we possibly can. God bless you. We'll see you again next week.